Time for our weekly market review, which we do every week, obviously, because it's weekly. And you can tell by my terrible picture quality that we're doing this late night. But not really, it's just raining outside. And now that I've wasted your time talking about the weather, let's get into the market review. But first, a quote from Henry Howard Harper from his book, The Psychology of Speculation. When once caught in the maelstrom of stock speculation, the average man becomes more or less mesmerized. And at critical moments in his conservatism, his resolutions and his theories all take flight. Under the discomposing influence of a rapid succession of changing values and alternating impulses, he loses his perspective, is incapable of calm reasoning, and is likely to do precisely the opposite of what he had intended to do. And I'm sure any of you who have traded in the stock market have experienced this. Everything changes once your money is actually on the line and things get going in the market and there's excitement. You see all the flashing lights, it becomes like a casino and all your best plans are thrown out. The biggest thing I did to help myself through that was convert over to systems trading, which is exactly what we talk about in this free training. We talk about the strategy that I use and most of our Fallible members use as well, which is actually a system. If you want to check that out, there's a link in this video and down below in the description and comments. Free training, you'll learn all about it. But the nice thing about a system is when you have those back-tested results and you know you have an edge that works day in and day out, you can kind of turn off your brain and depend on the system that you already built beforehand. So in those times when you actually have to make the trade where it gets the most emotional, you're able to check out because all the work was done beforehand. But of course, even with the system, you still have to follow it. And that's why all of our members who use that system also get our psychology training, which is probably the most important content I've ever done. Absolutely key for the markets, which I'm sure Henry would agree with, because markets, it all comes down to psychology. Moving on to markets, one of the things that we keep our eye on the most is narrative and positioning, so sentiment. And you remember how that works. When people are really bullish, it's actually bad for the market. When people are very bearish, it's good, because if they're bearish, that means they haven't invested all their money. They haven't converted yet to becoming bullish. When everyone's bullish is when everyone becomes over leveraged, and then where's the rest of the money going to come from to push prices higher? So that sentiment has been a strong tailwind for risk assets these past few months. But now it's turning around. You can see right here this green line that tracks it. This Investors Intelligence Bulls and Bears survey. Ratio bull to bear, where previously it was all the way down here because of that CCPV crash, it's climbed right back up. So now this sentiment and positioning are becoming substantial headwinds for the stock market, meaning the trend has become more fragile. This is a bearish sign. Speaking of the CCPV, it looks like there's been a turn in new case growth and hospitalizations. You can see these charts right here. It looks like the peaks have been hit. Plus, there's growing evidence in support of the lower herd immunity threshold. They're now thinking that that could be reached around 50% or less, which would explain why the states that were hit hard in April are not seeing that second wave this summer. That's also why Sweden is doing well on a relative basis. And that is great news, because me personally, I've been one of the people who has been quarantining the hardest during this. And at this point, most people just think I'm crazy. They're like, seriously, AK, are you gonna stay inside forever? No vaccine is coming for a long time. You're gonna miss this, this, and this. Don't you wanna see people? Of course I wanna see people, but maybe it's because I sit here and talk with you guys about risk all the time and we're watching markets all the time. But the risk reward of a lot of the things that everyone feels comfortable doing again, like going to restaurants, it just still doesn't make sense to me. Because the virus is kind of like Russian roulette. You don't know how it's gonna affect you. So in the best case, you have mild symptoms. In the worst case, you die. So in the stock market, we talk about risk of ruin, right? We talk about always managing your downside so you don't get blown out, because starting from zero is extremely hard. So you're much better off cutting your losses, even if it turns out you might have cut too early and the stock market takes off. So in that same sense, when I think about the virus, the risk of ruin is death or serious illness. And why would I take that risk? I was watching The Last Dance. I'm in the middle of it right now, which is the Michael Jordan documentary, which was on ESPN. It's finally on Netflix now. And in one of the episodes, they were talking about when MJ broke his foot. And MJ wanted to play when the team made him sit out. And the owner of the Bulls explained it very well. He said, listen, if you have a bottle of 10 pills, 9 of those pills will cure you completely, but 1 of them will kill you. Are you going to take any of those pills? And that was a good way to look at the risk. Because if MJ did go back and played on the foot before it was fully healed, it could be career ending. But everyone still thinks I'm crazy for it. The only people I know that are being super careful are myself, Alex from Macro Ops, because he has that same risk control idea, and the other guys that I work with, because we're all involved in markets so much. We'll see what happens. Maybe we're being stupid, but our lives are all about managing risk, so it makes sense that we would do this. But going back to markets, what's interesting is that the current narrative is really bearish on the CCPV and on the economic recovery, but it's also increasingly bullish on risk assets because of the Fed just propping them up. up. But what if the case growth actually slows much quicker than is currently projected? And at the same time, we get a new round of fiscal stimulus that we've been waiting for, which unleashes a bunch of pent-up demand. That could be a recipe for a massive bull market. This chart from UBS shows the projected deficit of the US. You can see it's getting crazy here. So this is going to continue to put pressure on rates and especially the US dollar in the coming years. Spend, spend, spend. So going along with the thesis that things might not be as bad as we think, there may be a mispricing in the long end of the US curve. So we're talking about bonds here. 10-year yields are lower than they should be, and there's an increasing chance that we see a move higher, meaning there could be a bond sell-off. UBS thinks that the Fed is likely to embrace any long end sell-off if it's accompanied by wider inflation break-evens and stable to easier financial conditions. And if that sell-off happens and yields pop higher, that's going to affect everything else. Because you remember that stocks and bonds, they compete for cash flow, right? So money always goes where it's treated best. So if there are higher yields in bonds, you might see some of that money flow out of stocks back into bonds. It's like a balancing scale. Looking at the dollar here, commercials currently hold a rare net long position, meaning that the specs are very short. And this is kind of how you look at commodities and currencies. Speculators versus commercials. So what this means is that the positioning is pretty crowded on the short side right now for the dollar. Plus the tape looks like a short-term bottom may be in. So we are bearish on the USD long term, but it looks like you could get a bounce here because things don't go straight down. So one of the important things you need to look at when you're analyzing currencies is those speculative flows, because it's hard for the dollar to materially weaken when relative equity momentum is favorable. So you'll see equity momentum fall along with the dollar. But the fact that the dollar has fallen so much despite the stock market continuing to go higher every single day, that should tell you what's going to happen when the stock market finally does turn around. Then look out below for the dollar as well. The energy space is another area to look at, because for the first time ever, energy has the highest dividend yield of any sector. And that happened because these stocks have been beaten up so bad. 2020 has been the worst year ever for these energy equities. You can look at this chart right here. The big black line are these energy stocks. They're just crushing everything else in terms of dividends. First time ever, it's the number one. So this will be a good area to pick up some left for dead companies. Once the dust settles, you can't get in there too early. And that's another thing we know about markets and sentiment. A lot of times if there's a sector that's really hated, all the stocks get hit, regardless of the fundamentals or anything like that. When you look at a stock, 50% of its movement comes from the overall market. So say if the NASDAQ or the S&P is going up every day, you'll probably see that stock go up as well. 30% comes from its individual sector. So oil stocks all getting hit because oil collapsed. And then 20% from the stock itself. So that's where you go into the individual fundamentals and say, oh, they have a much better balance sheet than this other company. That's what you kind of got to remember when you're in the stock market. That at the end of the day, most of the time you're playing the overall market. You're not going to find the few winners shooting up when the entire market is collapsing. Same thing if the entire sector is collapsing, it's going to be very difficult to find those winners. So that could work against you when you're trying to fight a trend, but it could also work for you because there can be a lot of undervalued companies because of it. So again, in this case with the oil, if every company is getting thrown out the window, no one's looking at the fundamentals of each individual company, then there's going to be some gems in there that are way undervalued. And we've talked about this strategy before, like the grave digging strategy. You find the few companies that, hey, the market did not evaluate properly at all. These guys are going to take off, and you get in them while the market sentiment is turning around. Now, of course, the problem there is timing. So hardcore value investors, they're never going to time it, right? But what we do in macro ops is we use that value analysis, but then we put that technical analysis on top of it, because we don't want to be waiting around with that dead money. And we don't want to be getting into something too early when it's still dropping, which is exactly what we mentioned here. You want to wait until the dust settles in the energy sector. But the technical analysis can tell you when the market is reevaluating those certain companies, when you see them start to spike. Then you could put your money in and get that return. It's a way safer way to do things. And it's one of the best ways to combine fundamental with technical analysis and sentiment analysis. And that's the Marcus trifecta. Michael Marcus, Market Wizard, that's what he talked about, which is why if you could do it, and remember, it's not super easy, you can make a lot of good money from plays like that. And we've done that exact play over and over again in the oil space, because there's been multiple times where they've been beaten down unrightfully. Moving on, since bonds are basically yielding nothing or less than nothing after inflation, institutions are now looking at large free cash flowing corporate equities like bonds. So where are the companies that are huge and producing a lot of cash? One of them, of course, is Apple, probably the most popular one. And that's why right now it's trading 4 standard deviations above its 200-week moving average. This has only happened 4 times in its history. The other few times were in 91, 2000, and 2004. It's getting ridiculous in this stock right now. We'll We'll have to see if it turns around or if Powell keeps it going. And finally, Twitter is starting to look pretty good. You can see it's starting to complete its monthly cup and handle pattern, and the daily average users on the platform are actually accelerating. So you got a fundamental and a technical push right here. This might be one to watch on a breakout. And remember, if you're looking for a full systematic strategy, check out our free training here. There's a link to it in this video and down below in the description and comments. Bull market, bear market, it doesn't matter. As long as you got your risk control in place and a solid edge, you'll be able to profit, which is exactly what we do here. So definitely check that out if you haven't already. So all in all, the market is definitely getting overextended, but it doesn't look like we're about to face a crash yet. But we're gonna keep monitoring that for you. So if you wanna see that, make sure you subscribe so I can see you in the next video. Stay fallible out there. Bye.